All right, what's going on, everybody? So it looks like that turned into an inverse cup and handle with a continued move lower rather than a double bottom with a bear trap that ripped higher. Hey, what y'all doing? So it looks like I called that out pretty good. The question was when price came back down to the low of the day today, if it was going to be a double bottom bear trap, which would be a bullish play back to like the 1 hour high or the high of day, or if it was going to be an inverse cup and handle, which is bearish and would likely send us lower. And it looks like it was an inverse cup, and we got the handle, and now we're going lower. At least for now, that's what we got, right? Take what we can get. I've been vocal on this over the years that the textbooks and my approach for a double bottom versus a cup and handle are a little different. So, what the textbooks like to tell you about a double bottom is that when price comes in and it sets that low, well, shoot, it's erasing as we go. Let's fix that. No erase, right? No, no, there we go. So if we had price that came down and set a low, let's go a little farther away than that. There we go. So at this point, we had two lows. If price comes down and matches the low equally, in the textbooks they'll say, "Oh, hey, that's a double bottom." I disagree because the textbooks also say that double bottoms are bear traps. Well, have you ever seen a trap work if whatever you're trying to trap never actually got into the trap? No, it doesn't work, right? You have to get them in there or you don't trap anything. And in this case, why would the bears get in? We've got matching lows. They're not going to get in with matching lows. Or even worse, the times where we get a double bottom and we didn't even make it back to the previous low. They're not going to get in there. You're not trapping a bear if you can't get him in, right? So I've always argued that when it comes to a good double bottom, that we would want price to have set that low, and then we want to exceed that low with a new lower low, because then the bears will get in. And then once they do that and we spring the trap, what we want to see is a very violent move to the upside. I mean, really violent. The the more violent the better because they're buying back to exit their shorts and buyers are trying to trap them and they're also buying and you get a lot of and it was a real beautiful reversal. Strong price, but not as strong as we would have wanted. It looked good, but read the wicks, read the candles. It wasn't all that good. The first recovery bar closed under 50%, left a lot of wick behind. The second one did better, but it barely closed outside of the range of the first one. And then the third one closed inside the range of the second one. Not that good of a bear trap, right? what kind of bear are you trapping when it barely got outside of the line and it closed back inside again? Nothing, right? So a micro bear. What do you call those? The Care Bears? You remember the Care Bears? You're old. You know those. Yogi Bear, the Smoky Bear. Only you can prevent forest fires. So I've always argued that if it's a matching low, or if it didn't even get back to the low, that you don't have a double bottom because that's not a bear trap. Instead, what you more likely have is an inverse cup. Now, you can get the occasional trade that will present with a low that didn't match and it turns bullish and runs, or a matching low and it turns bullish and runs. Sure, I mean, it happens, but more often than not, if you're preparing for price action and you're trying to figure out what's going to happen next, and you get the sort of setup that we're talking about with matching lows, or in this case, just barely deeper lows, read everything that the candles are telling you, and there's not a bullish impulse here. It could we have taken a long trade? Well, yeah, it gave us 5 to 7 points, 10 really, if you think you can hit it top to bottom all the time. But that's not a good double bottom bear trap. And look at what we ended up with, a really nice inverse cup and handle with an expansion to the downside, right? So we just want to read what we have and try to make an informed decision off of the outcome. What I see a lot in the chat, and it's kind of sad, but I remember when I was new, I very likely was doing the same thing, is that people are focusing on the minutia and the technique of different things as if it's going to solve the problem, right? Forget the idea that they can't perform technical analysis and define where price is going, why they think it's going to go there, and where it's going to go next. Instead, it's just, well, if I draw the line in the right spot and I get in on that line and go long or go short or hold, that's not going to solve the problem, guys, right? You can't paper trade your way to success. You cannot. It's going to come from education, reading books, watching videos, blogs and articles, and just learning education, not paper trading. So, yeah, learning the different techniques, tactics, strategies, it's going to help, right? Of course, it's going to help, but it won't solve the problem, which will always come back to, can you define what price is doing now and what we think it's going to do next? A lot of times when people ask me, hey, how do I get better? I say, go back and read the chat. Look at the things that I post where I point out, I think it's going here next, and then it's going to turn. I think it's going there next, and then it's going to turn. It's going to pause. It's going to reverse. Do that. You can do it on your own. You don't have to do it in the chat. Write down, I think it's going here, and then it's going to pause, and I think it's going to turn. Why do you think it's going to do that? The answers will be right there in front of you. If you are right, you'll do it again and again and again. You'll build your confidence. You'll prove to yourself that you can anticipate what price is doing next, and then you can learn to start trading it. But if you can't tell me where price is going and why it's going there, you're not going to successfully trade it. The end. That's it. Right. And hey, don't get me wrong. I am not accurate all the time. Right. Nobody is. But I trust my work enough to put money on the line because I'm at this point, I am a believer in what I do. I've convinced myself that I'm good enough at it to put money at risk. So don't get too hung up on the minutia of the different tactics and strategies of how is somebody doing it. They just did this one thing and they're making money consistently. So then what? You run over and you learn that one thing hoping you're going to make money consistently, and you don't. It doesn't work out for you. And then you see somebody else consistently making money. So you run over there and try to figure out what they're doing to see if you can do it too. It doesn't work out. And then you run over to the next group and you see what they're doing. It doesn't get there, right? It won't. You won't ever reach success that way. Okay, that's my rant. I'm done for the day. Let's eat jelly beans. We had a good question about how to draw things, and there's some work that I've put in over the years on this topic, and then there is some videos that I've done. So I answered this question in the questions tab area, and I've got somebody going through all the videos in the live stream replay that are mine. They're not doing every video that's in there, they're just doing my videos. But they're going through and they're listening to the videos and they are writing up a general description of the things that we talked about that day in that stream. It's a work. Ha, my wife, because she's such a sweetheart. Yeah, she's such a sweetheart. She's always asking, "What can I do to help?" Well, since you asked, why don't you watch all these videos? So yeah, she's doing that, right? I've asked her more than once if she wants to learn how to do this, and she is not interested at all, not even a little bit. But she loves to help, and I replaced her income years ago, so she doesn't have to go, work for a living. I keep asking her, just go find something that you love to do, right? Work isn't really work if it's something you love. And she's like, I just like helping you out and hanging out here. So that's what she does. Hangs out and helps around here. So at some point, we're going to have all my videos in there with a labeled description, giving people an idea of if you watch that video, what you'll find. For this question about the drawings, I knew I had done it. I was pretty sure I had labeled it. So I went looking for it and I found it. So if you go into the questions tab, you'll see the restream. And I went and watched it. It's like an hour and a half into the live stream that day is when we finally get on the topic. Before we get there, the other things I talked about that day included free material from places like the OCC, the OIC, and all these other options uh, websites that are connected to government and how options function. And they're just the really big dogs, right? The Chicago Board of Exchange, Options Clearing Corporation. So it's a good video. It's really insightful for options traders and then of course for measuring things. But I also added two blog posts that I had wrote on this topic over the years. So this is my website. I'm not a website developer. There's nothing fancy or shiny here. Just hit blog posts. Don't even worry about logging in. Well, that's weird why it did that. Never seen it do that before. What's wrong with you? There it goes. That'll bring you to this page, and then you can just scroll down to find what we're looking for. We're looking for measured move 1 and 2. Now I put the link in there, so you don't have to actually go looking around, but take a look around because I did cover some other topics of interest that you may find value in. This is a public website; it's free, so of course I didn't put any really great stuff on there, just common sense things that I've picked up over the years, including measuring things, right? So those blog posts go into what we're going to cover today. Um, there's no wrong way to go when it comes to measuring things. And the prevailing wisdom that is out there is what I disagree with. And it's why I made my own approach, which hopefully encourages you to make your own, right? Or to at least understand that you can't do it wrong if you can prove that what you're doing is right. All right. So let's start with the basics and just the textbook stuff. I'm going to draw my fibs because later I want these lines back and I don't want to have to rebuild it. So I'm going to draw that there and then we'll go to a different market. And then I'll just reset the drawings. Most brokers have a default Fibonacci drawing and they don't vary all that much, but there are a few restrictions depending on the broker that you use. I'm going to reset mine back to the factory default and then just delete this and start over. This is your standard Fibonacci, right? Maybe I shouldn't have drawn it that big because there's some that are off the board there. So as you can see, there's some way up here. Now I'm going to stretch it out a little bit. We've got 0 through 100. They did add 50, but 50 is not a Fibonacci number. It's a quadrant line. Then we got 23, 6, 38, 2, 61, 8, 7, 8, 6. Outside of that, we've got 1, 6, 1, 8, and then 2, 6, 1, 8, 3, 6, 1, 8, 4, 6, 1, 8. All right. And it just keeps going. I don't use any of those 160 somethings and 200s and 300s and 400s. I don't use any of that stuff. When I was going through the books, and there are some really good books on Fibonacci out there, but they're old and they are not day traders Fibonacci books. They're just the logic behind Fibonacci. And if you haven't gone through them, they are interesting. Where I struggled to find any value is applying it to tradable opportunities. The textbooks always focus on the monthly, the weekly, maybe the daily. And then, depending on whose book you're reading or whose video you're watching, they'll tell you how you have to do it. And if you don't do it that way, well, then you're just doing it wrong and it won't work. Well, if Joe says you have to do it his way or you're wrong, and then Bob comes along and says that no, 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 Joe's not right, Bob is right. You got to do it his way or you're not doing it right. I finally got to the point where I was like, you know what? I don't agree with any of you guys. And how would I apply it to the intraday? And nearly every book said, don't apply it to the intraday. Don't even try it. It's not going to work. And they didn't really cover the issue about wicks or no wicks or gaps, anything like that. So I finally decided I'm going to have to just figure this out for myself. So I started to develop a couple of rules about what I was allowed to do and what I was not allowed to do. And then the application of it and moving it. I move my fibs on breakouts and trends, right? And I keep applying the new measured move because price continues to expand. I will redraw the line and measure a new level and then measure a new level and measure a new level. And they say you would never do that. Don't do it. It's wrong. You're just screwing it all up. And I disagree, right? It's easy to talk about the disagreement, but I don't just disagree with them. I trade on that disagreement. I've been using my style now for a couple of years, and I put my money on it. So we can do whatever we want. We just have to prove that what we're doing is consistent. So the textbooks will give you a predefined level. They'll say, pick a 1 year daily chart for an example. So check to make sure this is a 1 year daily. And then measure things from its highest point to its lowest point. Okay, that's not bad. I don't necessarily disagree with that, but for the textbooks, 618 is the magic number. To them, that's the golden piece of the whole puzzle, and I disagree. The reason for my disagreement is back in the day, on a daily or a weekly, price could pull all the way back to a 618 before it would continue on. And what we're trying to define here is as people took profit, were other people willing to come in and take their place? And if they were, how aggressive was that? And could they continue the drive in whatever direction you happen to have been going? Well, that may have been true back in the day when people were still trading based on the newspapers or they were trading based on the publications that was sent out to them once a week in the mail. But we are way past those time periods, right? Nowadays, people are trading in sub-second markets. We don't wait days, weeks, and months to get information to take a trade. And I don't think that we need to wait for price to get all the way to 618. And in fact, if it goes beyond 786, I consider a trend no longer to be valid. That I don't think it has the strength and conviction to be something that I want to put my money in as a trend. It's not to say I think we're going to reverse just because we made it through the 786 and continue to go lower. Just that if I'm looking for a strong trend with momentum behind it and price crosses below and closes under 786, I no longer have conviction in that strength or that trend. What I've noticed though a lot is that 786 is the pullback. We got to think about what price is always doing, right? It runs up for trend, right? Is what we're talking about. Pulls back, runs up, pulls back, runs up, pulls back, runs up, pulls back, blah, blah, blah. Just keeps doing it over and over again. Most of the time, we're looking for that pullback to be a 786. And that's what I really like about it, right? But if I draw the drawing here and it pulls back to my 786 and then it begins to break out again, when do I draw the new levels? Right? When does this ever get a line that says 786? Well, at some point I would have to move the connection from here to there so that I got a new 786 here to mark. So 786 to me is really important because it helps me define how much of a pullback are we getting, and have we pulled back so much that the trend is in danger of breaking, and or that the momentum of the trend is gone, it's waning. I no longer have conviction or trust in the trade, and I don't expect that we're going to continue to go much higher. And to me, that's 786. Once we begin breaking below that, wicking around it, stalling on it, closing below it, then I really start to doubt that that trend has anything left in it. And if it does, then it can prove me wrong by getting back above the 786, right? Because if it gets above 786, that means it's going to 100. And if it can get above that, then we've got my other levels that we'll get into in a little bit. But we got plenty of room. I've got plenty of opportunity to trade. All it has to do is prove that it really is still strong and get back above that 786. So I say screw 618. I find no value in it whatsoever. Get it off of there. And as soon as you remove 618, well, you're no longer working with Fibonacci, because that is the number, right? That is the Fibonacci magic. If you remove that, what the heck do you have? Quadrant lines. 786 is basically 75. 23.6 is basically 25. I really don't need this 38.2 either. That's just the other half of the 618. What I mean by the other half of the 618 is this logic here. Some brokers, no matter how you draw the Fibonacci, is always going to put the number 100 at the top and 0 at the bottom. You could draw it starting like I did at the bottom and dragging your mouse up, or you could start by clicking at the top and dragging your mouse down. Some brokers will always put 100 at the top, no matter which way you go. Other brokers, like Thinkorswim, are a little more nuanced. Where you click first, because this is a 2-click drawing, that's where your 100 is going to be. So if you click high and drag down, 100's at the high. If you click down and drag up, 100's at the low. Well, when you do it this way, 786 can be the other side. If I had drawn it the other way around, 786 and 236, they're basically the same measure from 1 or from 0. All right, so this isn't perfect, but if we just draw a box here between 236 and 0, we take that box down here. Like I said, it's not perfect, but it's darn close. It's the same thing, right? So for me, 236 and 786, they're kind of the same thing. And 618, 38.2, they're kind of the same thing. They're just on the other side. So if you drew the drawing from the wrong direction, it would still work, because you're just looking for that 618 to 100, even if you're using the number 38.2. All right. So I don't use 618. I also don't use 38.2. And 23.6 is basically just 25. So that's a quadrant line. And 78.6, it's 75, and that's a quadrant line. And now we're done with all of those. When it comes to breakout and trying to find the reversals on a breakout, I spend a lot of time on a daily chart. I like intraday trading from here, at least looking for my opportunities. I'll go down into a smaller time frame. I'm not crazy, but a lot of times, especially like in equities, this is my preferred tradable chart because equities, I'm so used to looking at futures that when I do go to equities, I'm like, wow, your pre-market just looks horrible and all the nasty gap trash candles, wiki crazy wicks. I just come right out here and look at it on something like Apple, Microsoft, Google, and I'd much rather prefer just trading from right here. But if we look for an inside day breakout that fails, say, let's use this one back here. We've measured the previous day's range, which was this blue bar here. And the next day, price broke out of it and tried to run. Well, I like to use two lines that are called 1.111 and 1.236. I added these over the years because this 236 that Thinkorswim had as a default, I kept wondering, what the heck are you using that for? Right? Like, why was it even added to the system? Because I couldn't find any way, I couldn't find any value. Right. It is. 111, it sounded better and it was easier to write in my notes. I mean, just being honest. Exactly. It was so close that I was like, man, I like to name all my trades, my strategies. Do I want to call it the 111, which just rolls off the tongue so easily, or 118, which is like I'm chewing on something, right? Like got some bubble gum or something. All right, 111 works good. 111, 111. I like it. I just function wise, 18 would be just fine. But this 236 that it had as a default number, it messed with me for a long time. I just could not find a value for it. I'm like, I was measuring breakouts one day and I was turning on lines trying to fill the void that they have between, the one and then the 1.68 blah blah way up there. And I thought, well, hey, they've got a 0236, but they didn't add a 1236. Let's add that. And so I did. And I left it on for a while and I really started to like it. And then I started using it more. I realized I had never wanted to take it off. And then it just stuck with me and I've grown to love it. But there was something missing between those two, which is a 111. So I added that as well. When breakouts fail, a lot of times they get stuck on that 111 and they'll turn around and go right back in again. If we don't fail and we keep going, we make it to the 1236 and then we get the OCC, the opposite candle color. Now, I know I've had people say, so we're going to go red there. No, not necessarily. Or we're going to go bearish there. We're going to get to a high and we're going to break out and then we're going to get an OCC. So it's going to turn red and we're going to go down. Not really. No, more the idea that if it was green, we will see either a red candle or a doji, because that's actually the full sentence. We're going to get an OCC or a doji. So at 111 on the breakout, if we make it through there and we actually get to the 1236, if we were red, we would expect to get a green candle there and or a doji there. But just getting a green candle says that we're going to stop with the red for a moment. It doesn't say that we're going to turn green and go back up, just that the red is going to stop for a moment. And the same thing if we were going the other way around. Now we can get to a 1, 2, 3, 6 and have a failed breakout and come back in, right? Or a failed breakdown and come back in. It can do that at 1, 2, 3 instead of 111. But most of the time, If the breakout fails, it fails at 111 and then we come back in again. That's just, the way it generally works out. So what I try to tell people is you want to learn to apply this in all sorts of various market types and conditions because you can do it anywhere. There's no rule that says you have to apply it to, say, all of yesterday or all of Globex. You can put it on one single candle. I like to use the 5-minute open range a lot. So I'm on a 5-minute chart. You just take the drawing and you draw it on the 5-minute open range. I've done that quite a lot. You can also do it on big bars, what we call event bars, like the 830 non-farm payrolls or CPI, PPI, something like that. You can measure anything as long as you can validate why you're doing it and then prove over and over and over again that what you do consistently works. It doesn't have to work every time because nothing works every time, but it should work often enough that you trust it. So here's an example where we were intraday and we would have had the low of day marked. We'll just get out of the way. We'll just zoom in here a little bit. So at this point in the trading day, we had a nice drop down and then we started to consolidate down here. Once we start doing that, I'm showing you the default way, but I've got little nuanced pieces to all of this. I went from the lowest point to the highest point, only using the RTH. This solves the problem of, hey, should I use wicks and or bodies or only use wicks? In this scenario, I went from the absolute top to the absolute bottom and it worked just fine. There's nothing wrong with it. Now, I don't generally do that unless I'm looking for the real midpoint, because if that is the absolute high, and if at the time that I drew the line, if that was the absolute low, then this is the real midpoint. And I like knowing where that real midpoint is. So I'll snap from real high to real low, mark the real mid, and then I back up off of the wick in the direction the price is going. So we are in a down day. I'm using the absolute high, but I'm using the body on the low end of the drawing. If we were bullish that day, if these were green candles, I would have used the full low of the day, but I would have used the highest body part on the upside, right? That's just the way that I do it. Now you can see that the half is a little bit higher than the drawing that I had. So now I've got this little zone to be concerned with. I like that zone. It's better to have a range than a single line in the sand. And I've got my 786 because what we would be trying to define at this point is, okay, we've had price, it made the run down, and we've got the range top line in the sand at 786. What we would expect price to do if this trend is going to continue is pull back into 786 and then continue the move to the downside. That is your textbook bear flag with a pullback into 786 and the continuation lower. If it's not going to continue lower, then it would pull back to 786, break that level, and go to the half, which would be anywhere in this zone from those two lines that I drew. Because remember, we're not trying to aim like we're shooting a penny way off in the distance. We're looking for a zone or a level of resistance that we want to focus on. So if price gets through that 786, this is the target zone. It's where we're going. If we can get through that, then we'll target, like the RTH open and the high of the day. We got those levels. Now, don't get me wrong, we can pull back to a half and still go lower. That can happen, but it's not as common because remember, if this is a quote trend, we would expect to see people take profit and others happy to take their place. And it would just turn around at that 786 and it would go lower. So, yeah, we can reverse it to half and fall back down, but it's not as common. And so that's the setup that I'm looking for if we're going to have a trend day. So then we get the 786, we move lower, and we'll get into the 1236. That is the place where we're looking for an OCC or a doji. And once we get there, and I get my green candle or I get my doji, once that candle has closed, and I can validate that, yep, it's green, or yep, it's a doji. Now we'll move the drawings so that 100 is now where 1236 is at, and that gives us a new 1236 lower. If it doesn't work out that way, it'll be a reversal point more often than not. So price came down, we got the OCC, we snapped the drawings because until this bar closed, I never had a chance to snap the drawing in that whole run, which is fine because the market opened at 9:30 and we needed something to measure. Until you get a good 30, 40 minutes of price, you don't have anything to measure. So this was our first opportunity to snap the line. We snap it. We now have our pullback levels and our targets lower. All we got to do is see what we want to trade here. If we're bearish, we can be waiting around that 786 for a short entry. And if we're bullish, we could see how the next bar starts to form because this could be forming, like a big V on the day. We don't know what it's forming yet at this point, right? For all we know, it could be a V on the day. We need to uh, have a bias already so that we know what to trade. If we don't have a bias, we can sit out and wait for it to give us information and then we know what to trade. The next candle, if you didn't already have a bias, would start to give you one. And if it don't, then you wait for the next one and then the next one and the next one until you have something that's tradable. So here we didn't continue in the V shape. That takes the bullish V off the table. And we tested the 111. We didn't close down there either. We closed up here, but we at least touched it and it held. Moved up. We didn't get the 786. So we're not getting anything here. Nothing out of the market is giving us a direction. We're not bearish. We're not bullish. We don't know if this is going to turn higher or lower. We got nothing. So you can guess, you can assume, you can look at other products, dollar, treasury yields, FX markets, options markets. Maybe something will give us some clues, but price itself isn't giving us anything except that we're in a range and we're holding within the defined parameters, which is, I mean, at least that gives us something. It does tell us things. Now we got a real good test of the 111. This one back here is just a wick off. I don't really give those a lot of faith in my analysis. I like something like this. That's a true, real test of the 111. And we closed there too. I like that. That to me is a solid test. Same thing with this 1236. Yeah, we touched it, but I'm not feeling it, right? And we're definitely not closing even remotely close to it. So I would not move my drawing here, even though we could argue, hey, it hit 1236. Yep, but I wouldn't move my drawing because we didn't close near it at all, or at least on it, right? Now, when you get to moving your own drawings around, and you got to have some rules. It's hard to articulate at what point I would move the drawing from this because I don't have a good example to show you yet. But that little wick off can be used because I have two ways of doing this, my way and then the way that I teach. Can we move the drawing here if I'm teaching? Yep. You can go to the low of the day from the high of the day. That is valid and you can do it. You don't need to have any nuanced little subtle pieces on any of this. Just keep it simple, especially when you're first learning things. You don't need complex. That works. All right. So now you've got the low and the high defined, and you actually have a real midpoint too at that point. It's not even an adjusted midpoint, it's a real mid, and you're good. You can use that. It gives you targets that you can then apply with the price action that you're working with, higher highs, lower lows, higher lows. And so that was a good example of a 111 that failed and flipped. Or if you did move it, it now defined the rest of the afternoon or the rest of the morning. I wouldn't have moved my drawing. I would have left it where it was. As you can see, though, that real mid was valid, right? It worked. So if you moved it, you were fine. You didn't hurt anything. And if you did the way I would have done it and left it alone, it was also fine because it was just clearly demonstrating that 786 through the whole afternoon. You can't get it wrong, right? Use high to low. Don't worry about the nuanced, subtle little pieces, and it works. Now let's find a breakdown or a breakout that actually continued to run so we can move the drawing again and again and again. And I've done this in picture form. If I can find the file where we had a really good trend day once. And of course, I was snapping pictures and giving people the next line, the next level, all the way through the move. And I ended up keeping those drawings so that one day we could go in and look at them line by line or application by application to show the whole move. I just got to dig it out of the box. Nope, that's not it. Those are event bars. We ought to get into those, but that ain't it. Yesterday's 111 examples. Those are good topics. That ain't it. Well, shoot. That's all right. We can do it without. It would have just been easier with. Oh, yeah. I think I got it. This might be it. At least this is some of it. Nope, that ain't it. All right, a little more digging. All right, we're going to cover this topic, by the way. I've done it before. We're going to do it again. Not yet, though. We'll get into it when we get to the half part. Let's just find a spot where we can demonstrate live moving the lines through a trend day. So here was a trend day, and we'll just walk through it the way we would have unfolded it. This is 8/19/2025, and I'm going to use TradingView because that will allow me to hide the candles that we're not using at the moment. So uh, 8/19. Just zoom out here, hide hold of the VIX, scroll back to the 19th. use the replay, and let's go to about right there. That'll do, donkey. Maybe a little more. Perfect. All right, so what do we have at this point? Actually, I need to go a little farther back, right there. To be clear for anybody who doesn't understand the color nuances on my chart, this lighter shaded area, that's Globex. The darker shaded area, that's regular trading hours. Don't get hung up on the word Globex. It just means global extended market hours, right? It's the overnight. Anything after the regular market close at 4 o'clock. So with what we've got right here, we've got the 5 minute, because I am on a 5 minute, the 5 minute high and the 5 minute low. We could just use that because it was a really wide 5 minute bar. If it's one of these little itty bitty 5 minute bars at the open, I won't use that. That it's worthless. No good to me. But that's what we got. We could use that. We're not going to though. I want to use the low here. Why is my hotkeys not working? Whatever. We'll do it that way. And I want to go to the high of the day. So lowest point to the highest point, price came all the way back down, broke the mid, but look what happened when it got to that midpoint. We fell and we bounced on the mid. They tried to defend at that level and we got a blue bar, green bar, whatever. It tried to bounce there and all it ended up doing was setting a lower high and then it continued to fall, broke the midpoint and kept falling. Cool. We would snap this from high to low and that would define the low as a target, and we would look to see if price can get there. And if it overshoots, we'd look to see what happened at the 111. And that's exactly what we got here. It got to the 111 and it was defended there and it tried to reverse. Whoa, that's way too much. So we got the reversal. It tried to come up. Is that the right day? Yeah, that's the right day. That's not the right day anymore. I don't use this go back stuff enough. There's the 19th. There's the bounce. We had a little bit of a pullback. Once it got to the 111, it tried to make a run for it, failed, rolled over, and then look at that dump. That just massive bar that continued to move lower, and it blasted right through the 1236. It didn't even stop there, and that tells me a lot. What I used to think when that would happen is I'd think, oh man, did I get my drawing in the wrong spot? Should I have done something? Why didn't this stop where it was supposed to at 1236? But that was the wrong approach. I didn't do anything wrong. In fact, breaking through the line with such aggression told me that it was overshooting its price targets, that it was very bearish. Otherwise, it would have stopped where it was supposed to. So this was just an aggressive low. But when you see that aggressive low, you also have to be concerned of capitulation maneuvers. So, if it overshoots and you think, wow, we must be really bearish. Look how hard we broke that line and it kept falling. Yeah, but, right? But be careful because if it's capitulation, it's going to flip there. So it finally did give us opposite candle color there. And now we can move the drawing after that bar closes. So we'll just back it up to right there. This bar closes and we can now move the drawing. And I'm just going to do the high to the low, but if I was by myself and not demonstrating, I would use the body on the low and the wick on the high. to the highest point. I don't know why that wasn't at the highest point, but there you go. Highest point to the body. Now we want to see if price on the run up can get through that 786 and keep going to the half, or if it's going to roll over here against that 786 or even before it gets to the 786 and continues to go lower. So don't hit that button. That brings us back to the real time market, I guess. We just hit this button so that we can get another candle or two. Yeah, there we go. Couple of candles. Now we're getting a lot of information here, right? If this was a bear trap, because look at that big Pinocchio bar, then we should have seen violent reversal to the upside. Bars that look like that, but green, right? Something that looks like that bar there. It would have been violent to the upside if we had trapped any real good bear traps here. Where are they? Right? And where's the big buyers that come with it? Instead, we've got wiki trash. Look at the next bar. It closed within the green bar. We wicked out, yeah, but we didn't get anywhere. Now, that by itself isn't enough because if we measure that green bar and mark the midpoint, we did close above the mid, but we closed inside that bar, and that's not showing me bullish bias. And then the next bar closed inside of that bar. Sure, we had an outside bar here, right? We got above and below that bar, but we closed inside of it. And it's still not bearish, but it's not bullish. It's not bearish because if we measure that bar that closed, it closed greater than the midpoint. So, still not good answers yet. We're looking for distinction and qualification and classification of a solid pattern, signal, or setup. And we don't have nothing. And we haven't made it to the 786 either. So on this pullback and this solid breakdown here, that's the first real signal that maybe what we've measured so far is continuing. You didn't have to wait for this bar. You could have got in at any time. What I would have been looking for is the midpoint of that bar, right? This last big bar, that mid 64.52. We didn't get there, but that's what I would have been looking for. In my drawings, what you'll often see me do is this little sort of a triangle. I draw that a lot, even if it isn't perfect on the line. I draw that even in my notes and in my journal to show, hey, I was looking for the mid, right? I was looking for the mid to catch a short off that mid bar. What looks like happened is we came up into the 50 line. Well, that was janky. It looks like we rejected off of that 50 and we never got to the 786, which is at 53. But that's all right. That's where our reversal started to show that it wasn't going to reverse and go higher. It closed outside that bar and it left no real wick across the upside, right? It wasn't indecision like these bars with wicks on both sides. This last green one had the same characteristics, wick on the downside, but closed at the high and it closed on the breakout. So it looked like it was, really going to go. But then it gapped down, closed the gap, and broke lower, and we're ready to go. And we didn't get anywhere, right? Now we've got these matching bars, they're almost identical. A lot of signals saying there is no control here. Something's got to change, but it's lunchtime and we're not doing anything because it's lunchtime. We're not going anywhere, just holding the line. That tells us something though. If we're holding the line and we're chopping around down here between 786 and 111, then we've got to see something change for us to get a trade on. We can't spend all day in that 10-point range. I mean, technically we can, but we won't, right? We're going to leave the range. So we want to start shopping around looking for information to identify which direction it should go. You don't have to do that. You can play long off the lows and short off the highs, and then long off the lows and short off the highs, and just look for price to do this until it finally does leave. That's scalper stuff. I'm not really interested in it, but you could do it. Otherwise, if we can close above 786, we run to the half. And if we can close below one, we aim for the 1236. We closed below the one here. If you had tried to take that, it failed. Right? We haven't had a chance to go off of 786 yet. And I had somebody ask me once, so you trade every one of these? No, heck no. I trade the ones that have the most influence, or at least the cleanest pattern and the cleanest setup. If it's a lot of indecision and wishy-washy and it's not clear, I don't bother. I just sit out and wait. A better one will show up. If this had been a solid V bottom reversal, a good, clear, tradable signal, I'd have traded that in a heartbeat. I wouldn't have waited for anything else. We didn't get it. And then we didn't get a good short because even this reversal wasn't a reversal off of the 786. It's not a good reversal. Now we've got to the 786. If that reverses off of the 786, it's a much better short than this one, which was in the middle of nowhere. Like that. Almost no wick across the top, solid breakdown, twice the size of the previous bar, and it broke the midpoint of this bar, which was actually like the midpoint of the last two bars. That's a good breakdown. It now needs to get through the low of those bars, which is really like getting through the half or the one. But that's a good short right off of the 786. And we've got our targets. If the low of the day is going to hold, it'll likely reverse around 111, maybe 1236. Otherwise, we're good on the short. We want to run it to the 1236, look for OCC, and update the drawing as we go. So a little bit of indecision, starting to continue the move lower. There's the 111. Still not there. Still not there. There we go. So when we get here, still can't move the drawing. We need opposite candle color or a doji, and then we can move the drawing. Not yet. Now, at the end of that bar, once it closes, we're now valid and we can move the drawing. We got a new 786 and we got new targets lower and a new half back too, so that if we do get through that 786, we can run it back to the half. Otherwise, we look to reject 786, roll over with a new opportunity to short down into the 111, maybe even down into the 1236. And if it can get to the new 1236, we'll update the drawing and continue the move. Made it to 111. We almost made it to the 1236, but we're not closing down there. That's the nuanced stuff. Now, as I showed on the last time we were doing this, you can move the drawing. Technically, you could. You could just use the low of the day, go ahead and move the drawing. It's fine. I wouldn't. I would wait until I got a real candle down there, or unless I start getting a collection of candles between 111 and 123. If we just start getting a lot that look like this and we're just hanging out here, yeah, I'll go ahead and move it down. Like there's the opposite candle color, and technically it's valid because of that wick. So what I do in this scenario, sometimes I'll move it down and I'll look at what the levels are. I might even, like draw a line here. What I'm looking for is, do any of them line up on 50? Do they line up on a cog line? Do any of the projections line up on a cog line? And if not, then I go and I just put it back. So let's just keep going. But you can shop around with the drawing, looking to see what you get. And now we got a breakdown. So at this point, you could go ahead and update the drawing. or just leave it where it is and say, I didn't get a good OCC yet, so I'm not moving it. That is a good OCC. So there's no ambiguity about that one. You go ahead and move the drawing. If we had moved the drawing earlier and it was sitting here now, that was a 111 reversal. So as I mentioned, you could do it either way, right? Actually, I had mentioned you could use the low, right? So if you put it on the low, you see how it's a valid 111. You can't do it wrong. I promise. Especially if you do it a couple of times and you can see how it functions no matter which way you go, it functions. If you had updated the drawing because of that green bar there onto the low of the day and the high of the day, you got a perfect 111 reversal right there. Right now, just because I didn't doesn't matter. We could do it either way. So now we've got the levels. We're getting the OCC. We got a new 786. And then we've got targets lower into the 6411 cog line. So fix it. You don't know how to fix it? No real test of the 786. There's the 786. You can see him defend it with those wicks and the candle closing below its 50%, although those are really small candles anyways. Back down to test the low. Now I'm using this go back system and marking it out one candle at a time. You can use the hard right edge to do this. It's faster, you don't need sophisticated software, and you can just go back to any random day in history and you can do it. It's certainly a lot faster than using this, although it's cleaner to use this, right? There's nothing showing over here. Just makes it a lot easier, especially if you're going to do pictures and drawings to help yourself out. I think this is a good example to use because it wasn't just good, clean, perfect trend all the way down. But I've got examples of those. I just have to find them because I've done entire trend days where it was just level by level, each new 111 getting broke into a 1, 2, 3, 6. And then we updated and it was a new level and a new 1, 2, 3, 6, all the way up into like 3:30 in the afternoon. Now you can see how everything changed, right? That big explosive outside bar. We are in power hour. We're right at 4 o'clock. The color didn't change the way it should at 4, but you could see how we had something significant happen, which was we made it to the end of the day. But you can update your drawings like that all day. And especially if we continue to fall, you can just keep snapping your levels right on down, 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 or up, right? It works both directions. Um, I do this sort of work on a 5-minute chart. It's what I do, right? I use a 5. All of my intraday price action targets using quadrant lines is always done on a 5-minute. That doesn't mean that it can't be done somewhere else. It's just that I always do my analysis on a 5-minute. And I look at monthly, weekly, daily, hourly, 30-minute, 15-minute. I look around. I'm running 2 computers at once, 4 brokers. I'm looking around. I got a lot of charts. But when I draw the drawings, and especially if I'm going to share it in the chat, they're always on a 5 minute. I keep that consistency to show that you can have a consistent chart time frame to use for your analysis and then do your trading somewhere else. I don't trade on a 5 minute, right? But it's where I do my work. And because I do the drawings on the same time frame every single time, then I don't have to worry about any changes from a different time frame messing anything up. It's always the same. What you'll find too, if you do it that way along the way, is that things start to have a repeatable image after a while. The the price action is the same. The way that they reverse is the same. So we've talked about moving the drawing. Some of these drawings I never move. They are set in stone because I'm measuring something very specific. Notice that 111 reversal? What I measured here was our Globex high and our Globex low of last night, right? This isn't cherry picking. This is just using what we had yesterday. So last night, that's the low, that's the high. If you measured that and you snapped a 111 and a 1236, our breakout today stalled at the 111 and we came right back in again. And so far they've been front running the low, so we haven't broke down. But if we do break down, we can put that 111 down here as well. We don't even have to move the drawing. We can just add the other side. So there's 111 and 1236 going the other direction. It's in the bedroom. I gotta hit timeout for a second. I gotta fix. I had to go get a new debit card, bank card, and now things like Amazon are saying, "Hey, your debit card is the wrong number." So I gotta fix it real quick. Be right back. All right, I'm back. So there are predefined things that I like to measure, like the Globex range. I also like to measure yesterday's range. It's called that's what I call it, yesterday's 111. And it doesn't matter if it goes to 111 or if it goes to yesterday's 1236. I'll take them both, but I still call it yesterday's 11 no matter what it gives us. When you measure yesterday, there's different ways to measure it too. You can measure just the RTH of yesterday, or you can measure all of yesterday. And of course, whatever is smaller, you measure first because, well, we have to get out of one box before we can get out of the other box. So if we snap the lines on yesterday's price and we broke out and we got 11 off of that, or a 1, 2, 3, 6, and then we keep going, then you snap all of yesterday. And then, of course, we have to get to the high of that and break out, and same thing, right? So those are predefined ones. You can do it in swing trading too, because you can do this on a daily, weekly, monthly, anything like that. Anything that has a range can be measured, which means you can do it on a single individual bar, like a 1 hour bar. I was talking to a trader, last month, I think, and he said he loved this technique that I use and that he was using it in a way that I don't. He goes out to the hourly bar and he measures the hourly bar, whatever it is. And I'm not going to try to explain his system because I don't quite understand what he's doing, but he measures that hourly bar and then he uses that with the same 786 and 111. And hey, I think it's great because, like I said, you can do whatever you want as long as you can prove that what you're doing is consistently viable or valid. Go for it. So anything can be used. I also like event bars, the PPI, CPI, non-farm payrolls, those 830 big bars. I love those things. They are fantastic for the entire trading day, a lot of days. So I did some work a while back about how do you get to the point where you can use this in your trading. And I call it learning to trust yourself or trust the pattern, trust the setup. I can sit here telling you about it until I'm blue in the face, but have I gained your trust? And a lot of times what it comes down to has is more of a nuanced question. Do you understand what I'm saying enough to trust the trade? And typically the answer is no. People don't understand the nuanced pieces of the criteria or some part of the system, and then they don't trust what they're doing. They don't trust the setup. They don't trade it. You have to build that trust. Well, how the heck are you supposed to do that? A lot of people think you do it by day trading it. They learn it and then they say, "Oh, I'm going to go day trade this for the next 9 months and see how often it works." And I get that, but it's going to take you a lot longer that way because you have to find those opportunities, which may show up once a week, and then you're sitting there, all week long waiting on something. So instead, what I recommend is that you go into the past and you find opportunities to draw it and lay it out and prove that it worked. And if you do that, what you'll find is that there are a lot of things that you can learn from it. I'm pulling up a file that I made on my yesterday's 111, and I built this as a little bit of a see, this is how I do it kind of a thing. But on the other hand, I also built it to start a new database. So let me bring it up and you'll see what I'm talking about. Yesterday's 111. Actually, that's 2025. So let's go back to 2024. Uh, July 23rd, 2024. It's a big picture of the previous day's price action. RTH only. We can see that because I'm only measuring the dark area. And we rejected off of the 1, 2, 3, 6. It's a perfect wick rejection. And down we went. And I have marked on the day so that I knew what it was, right? That way, if I want to go back and examine that day even more, I can do that. Now, when I go to the next picture in the line, this is also that same day. But now I'm on the intraday of that day. We had this price action with a pullback to the half, but that wasn't really what I was trying to highlight. It was, hey, once we had that and I measured it, when we ran up, we hit that 111 again, a new 111 and a new 1236, and we stalled out there. Every one of these candles tried to break that sucker and it couldn't do it, and down we went. So if we go back, we could see all that up here. It didn't look all that awesome at the time, right? At least from here, it didn't. But if we had measured that, that was a breakout into a 1236 all by itself. So this reversal off of the high, this 57.57 and that wick, it wasn't just yesterday's 111. It was also the intraday 111, or the intraday 1236. That's a like two levels of resistance right there. Now this is the 25th, measuring from the high to the low, only the RTH. We hit that 111 at like 4 in the morning. And while I don't have a 786, it really looks like that's what we ran up into. We bounced on the 111, ran up into a 786. Eventually, we got down into the 1236. Here's another one. And all I was doing to get these pictures is I was looking at, hey, did we break outside of yesterday's price action? And if we did, let me snap my drawings on there and see what price did after we broke out of yesterday's range. That's it. And yet I've got example after example after example, and I start to get more trust in my system, more trust in the drawing, the way that I'm applying it. And I get a lot of really good examples of what price does when it gets to my level. What does it look like if it gets there and just blasts right through it and keeps on going? And what does it look like if it wicks into that zone and falls away? The more examples I have, the more I can try to identify the next time it happens. Is it behaving normally, or is price doing something I haven't really seen before? Right? Because even if you can't put your finger on it, you kind of get a feeling for what normal is. And then, of course, if it's not normal, then it stands out. You're like, well, that ain't right. So, how do you learn to trust a system, and how do you learn to, figure out if you're doing it right? It's you go in the past and you do them. The more times that you do it, the better you're going to be at it. And eventually, you're going to start coming up with your own ways of doing things. I've got multiple clients who have taken this approach and changed it into their own way. So if you're hearing me talk about it and you're like, well, what else can I do to it? You've already done everything. No, I haven't. I could name 4 different things that other people have taught me on what they do with my system that I wasn't doing. I'm still not doing it either, by the way. It's theirs. I don't really want to do what they're doing, but they've proved that it works and they're doing it and it works. So you can take even what I'm doing and turn it around and make it into something that you're doing that I'm not. Still profitable as long as you're, consistent and making money. Who cares, right? I even have a client that really likes the 618, and to each their own, right? There's no wrong way to go. This is measuring only the Globex range, and that was look at that open, crazy big 5 minute bar at the open, a little bit of a doji that managed to break through the half. Didn't close down there, but it broke through the half, and then it ran back up closed as a doji, and that next bar shot us right through the moon. But still stalled out 111 reversal, and down we went. Well, what a day, huh? Now, this kind of work is the kind of work that I do for all of my strategies, not just this 111 strategy. Like I've said before, if you can't explain what your trade is, how are you supposed to trade it? And one of the things that I ask my coaching clients is, what does your trade look like? Can you articulate, put it into words, describe it for me, right? Paint me a picture. Most of them can't do it. If you don't know what it looks like, how are you supposed to find it? That makes it a lot easier also when you start getting something wrong in your trades. Say something breaks and the thing that you were doing that was making you money now isn't making money, and you're trying to figure out what happened. This used to be a good system. What changed? If you know what it's supposed to look like, look at what you're actually trading and compare the two. Now, this is something that I did once where thank you, baby. Where I went out on a daily chart and I started doing a walk back. And what I'm looking for in this walk back on a daily chart is the first half back test. This is a way to go out and do a lot of work in a short period of time. Because, crawling on the intraday charts, 15-minute, 5-minute charts, scrolling back, it can take all afternoon. And you won't even get anywhere, right? It just seems like a lot of spinning your wheels. So, what I did is I went out on a daily, took a picture, started marking out. I'm looking for candles that reached their previous day's midpoint. And that's what we had, right? This bar closed here. The next bar, even though it's green, it actually closed right there. That's why it's solid green. That means it closed lower than it opened, and yet it's green because it closed higher than the previous day's close. But it looks like it reached yesterday's halfback. So, using the daily chart, looking for halfback analysis, look at every single day and how the previous day's halfback level offered support or resistance. This is the first halfback we found working from the right to the left. Now, if this was my chart, just stopping my mouse there would have told me what day that was. I can write it down and go look at that day later on because I know that that was a halfback day, a day where we tested the previous day's half. Same thing here. The red day doji with the long tail, that big doji day, and it's the same candle, right? This is the same one. That one is what we're working with. It was measured and we marked the halfback level. So 475. The evening star reversal that came next bounced off of that halfback and rallied into the end of day because we're adding in candle patterns, right? Trying to find as much information as we can out of this. Because if you've got an idea of what the daily is offering, you can use that bias on your intraday. I find this sort of work way more valuable than trying to paper trade my way to success. All right, this was another halfback test. Notice that the red bar is hollow. It's not red like these where it's solid. It's hollow like that one and like that one. A red bar that is hollow closed at the high, not at the low. But it's red because it closed lower than the previous day's close. So it closed higher than the open, but lower than the previous low. It's a hollow red. So after closing bullish way up here, we gapped down all the way down here, and then we ran back up, closed the gap, and then faded and closed up here. But that was a half back test. So, still on the daily chart, I can snap my drawings and check how close to a half back that really was. That's not bad. That's a pretty close check on the half back. Here's the same thing, although this one was a little trickier to spot. Measure the candle. Look at that. It opened on the half back and with almost no tail, ran up, broke out, and doubled the range of the previous day. This is a TRB setup, by the way. Trendline breakover. I love that. I made a sticker on it and everything. That's a TRB right there. What's it owe us? Back to the previous high. And that's what we ended up getting out of it. So that sort of work, it's what I spend a lot of my time doing. Validating my own drawings, validating my strategy, my setup, my approach. For the liquidity gap that I was mentioning, here's a really good example of an intraday liquidity gap. If we had measured the half back on that, that was this bar. And then, of course, that big bar is a liquidity gap too. So after it formed, price went right back up and closed the gap. And then we finally fell down and closed that gap. And of course, this bar also created a liquidity gap. So after we closed that one, we ran back up and closed that one. Crazy. That was a wild day too. That was April 5th of last year. I don't know if this is PPI or CPI, but it was one of those 830 candles, almost no wick, closed at the other end, and we got the gap closed by 11 o'clock. Not bad. It's a really nice setup. Check out how it responded to the halfback. Same thing here. This one actually was CPI because I labeled it, and it was a little tricky. You see how it left that wick behind, and the next bar stayed almost entirely inside that upper 25%. And then the next bar is where we continue to expand. Then consolidation. We didn't really check the midpoint. We just paused down here. Finally got the gap closed around 11, 10:30, 11. Same thing here. I mean, look how bullish that was. Even if you never trade the gap close, if I can stop you from going long at the open because you've seen the Globex was so bullish, I can't tell you how many times I've seen people that are new show up be like, "Oh, it was so crazy bullish. I'm going long at the open." And then what? Get destroyed. But half back test, and then we got into the open and we got the gap closed around 10:30, 11. This is one of those 830 prints, but it's not a gap close. All right. Price already closed so close to where we opened that there is nothing to close. But that doesn't mean that this really big bar is worthless. What I always recommend to people on those days when we get CPI or PPI non farm payrolls and you get one of these big doji bars, mark it out and then mark the midpoint, which I believe is somewhere around there. I'm just I don't have my markers, so I don't know, but that looks about right. Mark that mid and then mark your 111 and your 1236 on each side because you don't know which direction we're going to go. And On these, mark your 50% too. So you'd measure this whole range right there. You'd mark that mid and then project it higher, and it would be up here. If you did that and you measured this bar and projected it up 50% and 100%, that's where we stalled out right here. And that shouldn't be a surprise because in the textbooks, they tell us about breakouts making measured moves of 100% of the measure. So if you have a range of candles, that's usually what they talk about, not a single bar. In the textbooks, they'll say, yeah, measure a wide range. I think the Russell is like the most consistent range bound product I could ever imagine. Take a range like that, that's beautiful, and then measure that range and project that measurement, and that'll be your targets. That they teach you that right in the textbooks. But what they don't really clarify is that anything is a range. One single bar on a daily chart is a range. So here we are. I'm on IWM and just zoom in. This one bar of yesterday is a whole trading range. All I got to do is go to a lower time frame to define that range, right? So if I snap using yesterday's high and yesterday's low, now we go into the intraday. That is the range. I just needed one candle to do it. The textbooks do have a lot to offer. You got to kind of read between the lines on some of it and be willing to try out something. Just go check and see if it works. You'd be surprised at what you can come up with. And everything that I've been talking about, it does work on a swing trade. Now, when it comes to measuring stuff, I've mentioned the previous day, the Globex, 5 minute candles, big event bars. But another thing that the textbooks talked about, especially when they use the words wrong, and I always hated that 'cause tell me I'm wrong. They would always say 1 year daily, go from top to bottom. But what if I only want to measure the last pullback and then the potential breakout of that pullback? So we'll go back to TradingView. That way we can turn candles off. And we'll just zoom in to this pullback in April. Or is that April pullback? Nah, that's too much. Let's keep it up here. August. So we had the high, we pulled back, and we want to know if we run up and we break out, what's the next possible reversal? Now you may have noticed I didn't use the absolute high here, and I just need to move that over. Right. This is not how I would draw it, but it's how we can draw it, and it'll work. So now we've got the midpoint. If price is running back up, we've got something to check against. Did we close above the mid? And that big reversal bull bar, it did close above the mid, which was fantastic. But then we gave it away. Then we got back above. Then we got back below and we closed above, but it was a big wild doji bar. Lots of indecision there. The question we're trying to ask with this drawing is if we break out, where's the potential for the next reversal or pause? So now we're back. Test the 111. Now think about it. If you were trading that day and you knew the ES was breaking out and running up into the daily 111, you would be a little concerned around that level, right? 'Cause you'd have to be a little nervous about that level. Even if you had drawn the drawing the way that I would have, you'd have still wanted to be nervous around that level. Using that high, that body, or that high, all three would work. But let's put it back to the high that we had, and then we can drop into the intraday and look at what price did there. That first day, it just ran right through it. Doesn't look like we've seen any real reaction to it at all. It was the second day that perhaps was probably a little better, but still, you knew where the level was at, right? We need to get above that to get to the 1, 2, 3, 6. And instead, we came back in to the 7, 8, 6, almost to the half. And there's our 1, 2, 3, 6 and our opposite candle color. So we can move the drawing up. Anything can be measured, right? So you can measure just the pullback in a range, or just the pullback in a trend. I mean, which is really cool that you can do that because you can do it on the intraday too. We can measure just this. We don't need to use the whole day, or we can, use everything we have. There's our halfback. If we were drawing it my way, that would be the halfback. And sometimes when I'm not sure, say I was gone and I just get back to the computer and I'm trying to figure out where my lines should be now, then I'll back them up and work the problem. So here's what we had. Price tested it, pulled back, broke down. My lines, once I did move them, would be right there. That would be, if I hadn't been sitting here trading it all day, that's where I would have ended up with my lines because that was the next spot after the breakdown. But we can use that or we can snap it all the way down. Either one. We could do either one. I'm going to flip my drawings around so I got my 7, 8, 6. There it is. So hopefully this gives you guys a better idea of applying those quadrant lines and Fibonacci's on the run and with preconceived ideas of Globex and yesterday's high and last week's levels, and encourages you to experiment. The successful traders that I know all have their own system, every one of them. I don't know one successful trader who uses somebody else's stuff. And it could be just the most minor change. It doesn't mean you have to go and, rewrite the whole entire system. But until you make it personally yours so that you understand what it is that you're doing, it won't work. We're not playing mahjong games where we're trying to match an image to a setup and then, pull the trigger. and we can't rely on red green systems and things like that. Yep, this is being recorded. Always, always. The only time it's not is when it was an accident. But even then, we had intended to record it. It just didn't get recorded. It will be posted in the streaming replays afterwards. Well, I would also encourage you to check the channel, the questions tab, because somebody asked about that in there. Scroll up. This is a video that I did during a live stream event a year ago in September on the 6th. If you go to about the halfway point, I think it was about an hour and 10 minutes in, I start talking about this subject. And then these two blog posts, I also wrote about this subject. Yeah, I mean, I this morning I was just hitting skip and like jumping ahead, and I was looking for it. It was about it was more than an hour, but less than an hour and a half. Hopefully that gets you dialed in. And the whole thing, I mean, the first hour I was talking about options websites like the OCC, the OIC, the Chicago Board of Exchange, and where you can get great free resources for options information. So it's worth watching the whole thing. But if you're just looking for drawings, that was more than an hour, but less than an hour and a half in. And I think I spent the bigger part of the rest of the video talking about this. So, it's got a lot of stuff in there. Hopefully today I proved too that you can't get it wrong. You can draw it however you want, but you do want to try to have some rules, right? Like I've got rules about how I do it, and they're my rules. I don't do really good with society's rules, right? I just tend to like whatever, you know, tell me to wear a seatbelt. I'll wear a seatbelt if I want to. When it comes to society's rules, I'm got a lot of gray areas. But when it comes to my rules, I really toe the line. I I stick to the rules. But you can do things how you want. And I have seen people adapt my system in ways that I never thought, uh, I never considered, and it works. What you can't do is try to mimic everything that somebody else is doing. That won't work, right? It just won't. One, you won't understand what they're doing. And so trying to just visually mimic it won't work. And then two, no successful trader that I know uses somebody else's system. I don't, out of all the traders that I know, not one uses somebody else's system. You got to adapt it in some way and make it your own, even if it's just minor changes. So that's awesome. You take those three and you tweak it and make it yours, customize it, and you'll come up with something absolutely amazing. And I've been here long enough that over the years, I've seen traders come in and grow into their system. Oh, it's an absolutely amazing thing. They get so excited because what they're doing finally works. Like we all have been there where we're new and we're trying different things and we're like, Nope, that don't work." And then you try something else, you're like, "No, that don't work." And you finally get something that starts working and you just get so excited about it, right? One, you're not losing anymore. Two, you start actually making money. That's a game changer. But at the end of the day, it's not about the lines or the indicators or the entry technique. It's about understanding what the hell is price doing? How did we get here? And where are we going next? And nobody knows for sure what's going to happen next. But you can have a pretty dang good idea of what's supposed to happen if A, then B, right? And that's the way I roll with most of my trades. If A, then B. And because I know what it's not supposed to look like, a lot of times I kill the trade before it gets to my stop. I don't I don't take the stop away. I still leave it there cuz I mean, I'm not crazy. I'm not going to trade without a stop, but I'll kill the trade before it even gets to the stop. All right? So you can take any tactic or any strategy and do this look back method. And if you use Discord, then you've got a central database to store all of your work. Uh, you can, I got a client that really likes MACD, and everybody's got their own thing. Nothing wrong with the MACD. It's really good at telling you what you have, and we can't use it to try to define what's happening next. But I've got a client who really likes this thing, and we went through the same discussion, the same concept. Is that, hey, if you want to use this for trading, you've got to be able to define what it's telling you into actionable, tradable logic. Go back in the past to what you consider are tradable signals and look at the outcome of those. When did it work? When did it not work? What's the rules for when to use it and when not to use it? Right? That way, you've got a clearer definition of, can I use it right now or not? Because indicators are not designed to be used all the time. And if they're not giving you a signal right now, rather than trying to read the Ouija board, you admit the fact that there's no signal right now and you leave the dang thing alone. And that's where I think a lot of people struggle when it comes to indicators. Now, me personally, I don't trade with them. So, I'm not advocating the use of this or any other indicator, but I'm not against indicators either. But if there's no signal, then just admit, hey, there's no signal, and then leave it alone. But what I found was people were so dependent on it that even when there was no signal, they're like, oh, well, it's crossing over. Look, the red above green and blah, blah, blah. Whatever, man. There's nothing there. You got to just admit that. But even the lack of something being there, that's still information. And the MACD is one of those that you can read like a paragraph because of the moving averages that are built into it, because moving averages can be read like a paragraph, and that's pretty awesome when it comes to technical analysis. Not all of it is so easily articulated. Let's see what we got. We might get something out of Apple after all. It's been consolidating. It was stuck under that halfback for a while. Then we had this big gap up on the earnings. We had to digest all of that earnings. And then look at that gap again today. Was some violence. I tell you though, I don't like it. It's good that we're in the upper part of the day and we're going to close up there. And the tail left behind, the big gap. I like that. But when price action violates what you had planned, but your bias keeps you stuck in the trade. Yeah, I get that. It's from the mindset, for me, anyways, when I was having this issue, it was from the mindset that I remembered all those times where I thought it was going to be a loser and then I closed it. And right after I closed, say a minute or two later, everything worked out, but I was no longer in the trade. I'd already locked in a loss. And if I'd have just stayed in, it would have worked. Those haunted me. So then I would see things are starting to unravel, and I'd be like, no, no, I remember last time this happened. I got out, ate a loss. I didn't have to eat. I'm staying in. And instead, it just got worse and worse and worse. And I ended up taking a loss that was not what I wanted to lose. And it was like backseat driving, where I would look back and say, well, if I'd only done this and if I'd only done that, stayed in longer, got out sooner. And then it's the pendulum effect, right? I never say that word correctly, but the pendulum effect is this idea of like the fulcrum point and the swinging stone, right? So if we have a trade and it's not working, but we stay in anyways and we hold it longer and longer and longer, and then we take a loss that would really eats us up, and we say, okay, well, I'm never doing that again. I'm never doing that again. As soon as I start taking some loss, well, I'm getting out of it. And then what happens? Well, we get 7, 8, 9, 10 of those paper cut trades where we're jumping out at the first sign of anything that's going wrong, leaving massive money behind that we could have had, getting small gains, no real losses, but small gains and a lot of money left behind. And then we miss a really good run and we say, all right, that's it. I'm done with that. No, I'm never doing that again. I'm gonna hold on longer and see if I can get more. Well, that's the two sides of the pivot, right? We're just swinging back and forth from one extreme to the next. And when we take that and add it to the look back behavior where we say, see, if I'd have just stayed in this trade longer, it would have worked. Why did I get out here? I should have got in here. And we like just running in circles. It doesn't get anywhere. So instead, to solve this problem, what I started to focus on is what was my signal. I go back and I look at the actual trade that I just took and I say, all right, on this chart, what was the signal that told me to get in? Where is it? Can I see it? If I do, I mark it. Now, where was my exit signal? And what I found a lot of times is I didn't have an exit signal. I had my emotions, I had my feelings, I had the urge to stay in longer or to get out sooner, but I didn't really have anything on the chart that said get out here. So if I did find that exit signal, where was my exit? Did it match the exit signal that I found? When was I way early? Was I way late? Because if I got out and then 5 minutes later I do see a real exit signal, well, I should have held on until I got to that. Or if I got out and I go back and review and my exit signal was 15 minutes ago, well, there was my signal. I didn't get out then. A lot of times markets will start to give us a warning before we actually get the signal. The candles will get smaller, the wicks will start getting bigger, the range will start to tighten up really, really tight. There's various signals out there. And so we can look for those too and say, was there any warning signs at all? Going back and looking at that stuff is what I call journaling, not a spreadsheet with my entries and my exits like a trade log, but instead a picture of my trades that I can go back and review those candles and look for things. And as I grow and my education expands as a trader, going back and looking at those charts 6 weeks, 6 months, 6 years later, I can see exit signals, liquidity, warning signs that never existed when I was taking those trades because I didn't see them back then. But I could see them now with my new eyes on those old trades. Journaling like that has been a game changer for me. Taking a picture of the trades and reviewing those trades, trying to find the answers of why did I get in? Why did I get out? Where was the real target and where was I trying to go? And at first, it was sad because I would look at my trades and there was no entry signals. There was no reason to get in other than why I thought we were going to keep going up. I thought we were going to keep going down. What was your signal? I didn't have a signal. I just had a bias. Same thing with my exits. I was getting out and I'd go back and look at the trades. What was my exit signal? Well, I really didn't have one. I had a bias that I needed to get out. Got to fix that. And of course, we all have had trades lose that we didn't have to have had lose. If we'd have just stayed in 1 or 2 minutes more, it would have worked. And sure, those suck, but you can't let them haunt you either. You got to just continue to run the system the way it was designed to be built to be traded. And if you do everything right and it still loses, you didn't do anything wrong, right? Like you can have the best trade setup in the world, and if it doesn't work, it just doesn't work. You got to cut it and let it loose. And I don't know how to teach anybody how to lose, right? Because I mean, losing's a part of trading. You have to lose. Nobody likes it, and I don't know how to teach it. It just sucks. I remember when I started trading, losing $10, that was a big deal. I lost 10, $12. And I remember driving home. I live an hour from work when I was working outside of the house. So I had a 1 hour drive to think about it. That $10 haunted me all the way home. 12, 10, it was less than $15. It really bugged me. But that's new trader thinking. And back then, just risking the $10 was like, oh boy, here we go. I'm going to do it. Now, put a couple grand on and go make a cup of coffee and don't even flinch. But losing is a part of trading, so you have to get to the point where you're locking in loss at an appropriate level, because we should never have an outsized loss ever, right? We can have the occasional outsized win, and that's awesome. It's more, more product than we expected. It's great. And if your system is designed to give you the occasional extra profit, great. But you never want your system to give you an outsized loss ever. Because that's the edge that we have in our portfolio, is to get those outsized wins once in a while. Losses should be consistent and never exceed a certain threshold, whatever that threshold happens to be. I do a lot of my trading in the pre market. And of course, since it's the pre market, I trade the NASDAQ. Um, the number one issue with the Globex is a lack of movement, right? That's always been an issue, lack of movement. Well, the NASDAQ, that sucker moves. So when I started trading futures, I thought, well, let's fix the problem of not moving by trading something that really moves. And so I was trading the NASDAQ. This was way back when everybody traded the ES and nobody traded the NASDAQ. This community, the entire bullish bears, everybody traded the ES except me. I was trading the NASDAQ. And they would argue and say the ES pays more. Yeah, well, the NASDAQ moves more. I can move 50 points, even if it's $20 a point. I'm still going to make more money than you because you're only moving 12 points. I'm moving 50, right? It makes more money. But in the pre market, it moves more. And if you're looking for liquidity in the pre market, the micro NASDAQ has twice as much traded volume in the Globex than the ES does. On some mornings, it has more traded volume than the ES and the MES combined. How's that for liquidity? Huh? More traded volume in the micro NASDAQ than the ES and MES combined. Not all mornings, but a lot of mornings. And it's almost always traded heavier than the ES on any given morning that you go in and look. There's more volume in this than on any of the others. So if you're trading in the Globex, consider trading the MNQ. I know you could do the NQ, right? Even I can do the NQ, but the MNQ keeps it small. And if you want to size up, just trade 40 of them. It's no big deal. You want to make more money, just get more contracts. The NQ doesn't have the liquidity as the MNQ. And yeah, I know they got matching price and arbitrage equalators. They got solutions to match its price product, but the MNQ is more tradable, in my opinion. I like it. I like it better than the NQ, and that's what I use. And we all know that the NQ is a wicky little bugger and that thing moves. If you can use a 2 point stop consistently, and I'm not saying you can always do it, but most of the time you should be able to do it in the pre-market. Then that means your loss is never more than 2.5, maybe 3 points because of slippage, right? If it goes against you, you can lose a whole point in slippage. You might have a 2 point stop, but you actually took a 3 point loss by the time you get out of it. That happens on the Nasdaq. It happens. But still, max loss 3 points, and yet you can get an outsized win on that thing where you're like, "Wow, I was only going for 20 points, but it ran 180, and it took me for the ride, and I made 180 points, risking 3." I know a lot of futures traders don't use watch lists. They don't even look at other products. They don't even look at their own product. But take a look at the average daily volume or the uh, pre market volume of the thing that you're trading. You'd be surprised that MNQ, that sucker moves. Look at it today, 1.5 million versus all these others that are still in the thousands. 3 times the NASDAQ, just shy of the ES. The ES is running at 1.3 and we're running at 1.5. But look at it in the pre market one of these days. That volume, uh, this thing is loaded. Now, to be fair, the MNQ or the NQ, either one, the NASDAQ, in regular trading hours with a 2 point stop, that's a lot harder to do. There's days where I do it, but it's like after lunch, closer to 1 o'clock, that sort of thing. Not anything before 10 a.m. with a 2 point stop. Nah, you're just going to get run right the heck over. Fast, fast, you get run over. Yeah, I mean, don't get me wrong. I like the ES. I trade the ES in the daytime almost exclusively nowadays. But in the pre market and after hours, to be fair, if you're trading it and you're like, dang, this thing ain't moving. Somebody poke it with a stick. Go look at the NASDAQ because it solves the problem, right? It was my solution, anyways. When I was trying to trade and I was looking at the after hours and I'm like, damn, this stuff just doesn't move. Well, the NASDAQ moves. So, you know, also, if you are trading after hours, make sure you turn the news on. I'm not a fan of listening to the news during the daytime when I trade, but if you're trading in the after hours or in the pre market, you really want the edge of listening to Asia open up, right? It's like Asia, just like our mornings. Asia wakes up, they start putting in the Asian earnings for the day. They start getting quotes from different government officials and heads of companies, and they tell you their market is bearish in the pre market or it's bullish in the pre market. Then you hear them come into the open, and you can watch that price action unfold in the ES and the NASDAQ as you're listening to them narrate their trading day. It gives you a lot of edge towards how the Asian session is going to open up. Bullish, bearish, what kind of earnings they had. It gives you edge into understanding what price is doing and helps you identify if that breakout's going to hold and we're really going to run, or if it's a fake breakout and we're coming down. If there's any uh, known, unknown news events, if they have job numbers, unemployment numbers, crude oil inventories, anything that can shake the market up, but from their world. Once you're done with Asia, you start getting ready for Europe to come online. Same thing. Listen to Bloomberg. Listen to them as they start talking to people over in Europe that are waking up, getting ready for the day, their news, their earnings, and then the open. If you want to trade in the overnight, turn the news on. Bloomberg's got the Bloomberg Asian market. So that's perfect, right? I've got XM radio, so I get Bloomberg through that. If you don't have it, consider opening up a long-term swing trading account in a place like Fidelity. Fidelity offers you Bloomberg Radio for free. All you got to do is have a Fidelity account and you can listen to Bloomberg all you want. It doesn't cost you anything. And it's not a bad place to go, for having a long-term swing trade account. I don't do a lot of active trading at Fidelity, but I do have an account there and I use them. I might even have see if this link works. I'll put it in the chat and then you guys just tell me if it works for you. This is the Bloomberg client from my Fidelity link. And I have not updated that in months. But click on it and see if it starts playing Bloomberg for you. Right now they're talking about Intuitive Surgical ISRG and its earnings. Nice. Well, there you go. Now, at some point that link's going to stop working, right? But I haven't updated that link for months, and it's still working. Yeah. Yep. ConocoPhillips. That's the next thing they're talking about right now. COP. So save that link and then just use it until it stops working. Then let me know. I'll give you a new one. But that's built right into the Fidelity app, right? Or maybe I got that off of the Fidelity website. I can't remember. But either way, it came from Fidelity. I remember that. Cool, cool. Yeah, if you're gonna trade in the overnight, you definitely want the Asian open, the Bloomberg Asia market, and then the Europe market as it comes on, because it gives you that missing piece, right? Yeah, like a 2 point stop and a 10 point target. That's my Globex trade, 2 for 10. I don't get 2 for 10. A lot of times, I end up with 2 for 20, or 2 for 40, but or I end up with a 2.5 point loss because you can get a 3 point easy a 3 point loss with a 2 point stop. It's just so violent. Yep, that's the sweet spot for me. That's usually around the time that I get into the office and really start getting some trades on. Sometimes a little earlier than that, sometimes a little later than that. And if there's nothing there, then there's just nothing there. You know what I mean? Like when I say I'm day done by 7, I mean it. And that doesn't mean I got a trade. I mean by 7 o'clock, either I got my trades or I didn't get my trades, but I'm still day done at 7. And if I didn't, that's fine. I'm months ahead. I got a monthly level of money that I need to make on the month, and I'm ahead by months. So if I don't get a trade that morning, I don't care. I'll make it up tomorrow or the next day, or I'll make it up in the afternoon. You know, the market has been so violent that the monthly goals that I set, I'm far exceeding those. But I don't update my goals, right? And the reason I don't is because sooner or later it's all going to stop being this violent. And this is the scary part for you newer traders. Back in the day, before COVID, the S&P had an average traded range. The entire 24-hour day was less than 30 points. It was less than 20 points some days. So we're talking about an average daily move of like 18 to 22 points for the entire 24 hours. Now think about that. That wasn't like one random sideways day while we were waiting for Nvidia's earnings. That was day after day after day after day. 4. So you had to be willing to, figure out how you were going to try to make money in a market that was moving in your time frame. Because remember, if it in 24 hours, if it moves 22 points and you're only trading from say 9 to 4, then you're already missed out on half the day's price action. For the 9 to 4, it might only move 10 or 12 points for the whole day. And it's like, how are you going to make a living if the whole day is giving you 8 to 12 points? You had to really tighten your game up. You know, in the current market environment, we make these big sweeping moves, 60 points up and 40 points down, and then another 30 points back up. Plenty of room to make money. Back then, no. And that's why I don't update my price target or my daily goals to have a higher level. Because if I get comfortable making, 180 points a day, when we go back to that environment, it's going to be hard to make those levels. I still, I don't stop when I hit those old levels. I just keep going, but I still need X amount. I zoomed in on the chart here to pre COVID, and you can just see the kind of price action we had, these small candles. And you might be thinking, well, yeah, but Sig, you're zoomed out quite a bit. I am. Yep. But I won't change the zoom. I'm just going to start scrolling over and look how much bigger the candles are. It is a different market, right? Look at the size of these things. And eventually, we will go back to an environment that was like it was pre COVID. We will do that eventually. I took the one that I found on TradingView and I adapted it to mimic mine, and it does a really good job, I thought. This is the one that I adapted, and this is somebody else. I took this guy's and then I tweaked it a little bit. So here's what I took. Let's put his on. Yeah. Okay. So this is somebody else's. It's not mine. And you can see when we turn it on, it gives you these clouds, the big prints, right? It's not bad, whatever. And then it's got these lines. And then I took the work that he did and I adapted it to make it look like that because, that's what my Thinkorswim looks like, right? So I can't publish it because, well, it's not mine, but I can share the code and then you can just copy the code and make your own indicator, which means you can't publish it either, but you'll have it. That's not what we want. Get out of all that. There we go. I left his name at the top because I don't want anybody to think that I'm trying to take credit for this guy's indicator. So I left his name on it, but I did tweak it to look like what you see here. And so I'd say it's a collaboration between him and me. He just doesn't know that we collaborated. All right, so that is the code. Just copy all of that, go to create a new indicator, paste it, name it, and then you'll have it. When you open it up, you can see it says 21 day, and it does have additional things that are built into it. I don't have any of those turned on, but there's a table and you can do multiple lookbacks. So you can do a weekly, a daily, a monthly, all kinds of stuff. I don't mess with any of that. I just leave it as you see it. And I don't know, I think it does a pretty good job. The one that I had on Thinkorswim for years only showed today and it never had a look back. And so I would try to tell people how awesome this thing is. And they're like, well, give me an example. What did it look like, in the past? I don't have the past. You have to go look at my posts. And of course nobody wants to go do that work. So they would just be like, yeah, okay, one time it hit the line. I'm like, not just one time. It happens all the time. But I couldn't show them because I didn't have a look back. Then I found TradingView had it, and we can go back and look. And so I encourage people, put that thing on, go back and look at how price reacts at those levels. And when it doesn't react, look at how it just shoots right through them like it isn't even there at all, because that's a warning too, right? Yeah, that's a handy thing to have, average daily range. I can't write Pine script, not from scratch. But if I find an indicator that already has what I want, I can adjust things in the code. I know how to do that. I just can't make my own indicator. Now, thanks to AI, right? Now we can just ask AI to do it and then tweak whatever AI gives us. And I've got a lot of respect for TradingView. They constantly add new features and they're bringing options in. It's really light right now. I mean, there's almost nothing, but it's growing. And soon we're going to have the most fantastic options indicators that we could never dream of even 5 years ago. I'm super excited about it. Can't wait. I think it's going to be so awesome. There's no other platform with that capability out there, right? Because even Thinkorswim, you can code some option stuff, some on Thinkorswim, but it's very limited, and it is a resource hog that'll bog your machine down. On man, if Thinkorswim starts digging into options on the code, whew, the machine gets hot. It starts getting loud, vibrating, and smoking like it wants to blow up. TradingView has started getting into options. They're just dabbling right now, but it handles it really well. And the visuals are so much better than Thinkorswim. And the choices, the opportunities, the things that you can code within it are getting way more sophisticated than Thinkorswim often. Yeah, mostly they do. When they don't, I almost always try to make a specific point of where it does and where it doesn't. I always try to point out very clearly if what I'm showing won't work across the board. And there are some things where it's true. They just, you're like, nope, that's only for futures, or nope, that's only for equities. But most of what I show is for both. I've got a trading view indicator for options. It's not a paid, well, it's supposed to be a paid one. I'm only using the free one, and it's okay, for being free. Um, if I was to activate it, it would be even more fantastic. Just I don't buy indicators. I think I think it's this one. Well, I'll check and see if it is. That's the one. So I've got a couple of these saved. This might not be the exact one that I was looking for, but it's got the options levels, so that'll do. It's probably hard to see on the screen, but this is looking at puts and calls from a live broker. Of course, I mean, not now because the market closed, but when the broker was live, it was reaching out and fetching options data, matching it to the time frame of your chart, 44 days, because I'm on a daily. If I go out to more candles or if I go to a weekly, this will update how far back it's looking to calculate the put wall and the call wall and the next gex, all of it. It's fantastic. It's smart, recognizing the time frame that I'm on and moving farther back on the expiration of the options to define its look back period for support and resistance and structure and liquidity. And this is just the tip of the iceberg. It's also showing you the expected move range based on price action and the options liquidity, the traded contracts that define the expected move range. That's smart, man. I mean, this is fantastic. I can't wait till they really pimp this thing out. So if I drop down into let's go higher and see if it can handle it. It was at 44 days. Now it's looking at 835 days. Oop, there, where'd it go? Yeah, 835. So it adapted because I went to a weekly chart. It's looking farther out. Drop it down into a 1 hour and it'll start looking a lot closer. 44 days, October 17th. And this is the free one. Like if I paid for it, it would do more. And because it's free, it's only going to do these names: Oracle, Tesla, the Dow, Amazon, Apple. If I try to go to a market that's not listed here, it won't work. And because it's free, it's not updating constantly. I think it has like a 30-minute stretch and then it'll reach out and ping the server again. It might even be only 3 times a day. I can't remember which one. Some of them only ping 3 times a day, some ping every half hour, but I'm on the free one, so I'm limited in what I get, right? And I don't care because I'm just looking at what's out there. I don't use this to trade. I'm not going to pay for it, but if I didn't have things like stock charts or Trady ticks and black box stocks, cheddar flow and spot gamma, if I didn't have all of those services and I was looking to buy a service, this isn't a bad way to go. That's pretty damn fantastic, and it does all the work. I think it's pretty cool. You know, their name is oh, I'll find it here. Tanaku Trade. I'm sure I butchered the heck out of that name, but whatever. It does IV rank, call put skew, volatility skew, delta curves, all of that. That's pretty cool stuff. And then, of course, it's linking to Tasty Trade to get the information. So I think the potential when it comes to brokers that are out there, TradingView has room to grow. These guys, whew, they're going to explode in the next year or two when they really, really get that options data dialed in. Every options trader that I know is going to be on this thing. So if you see them offering a special, consider it. They just had one, 80% off. They probably won't have another one until Black Friday, but it's coming, you know. If you don't want to wait for Black Friday, what I recommend people do is the old rope-a-dope. Sign up for a month, use it, let it expire. Check your emails. They'll try to get you to sign back up, and they want you to re-up before it actually expires. So they'll be sending them early. Look for 80% off. If they're not offering you 80 off, let it expire. After it's expired, they'll still send you an email and say, hey, well, if you want to come back, here's this special. What they offer for Black Friday was 60% off. And then at some point, I picked up an 80. Just 2 weeks ago, they were offering 80. It's very likely they'll offer you 80. Still, either one of those, 60 or 80% off, is not bad. And that's pretty damn good. And that's what I got for you guys for today. Let's wrap it up, and we'll be back Friday. If you have topics that you want to hit, let me know. I'll get material on it and come in prepared. If not, I've always got a topic to cover. I think we're gonna do a little bit of looking around the market since we made it through Jackson Hole without having issues, and Powell gave us the Fed put. So everybody, be careful, be safe. I'll see y'all in the morning briefing.